Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios for today's podcast. A lot to talk about today. Post election, we have a Fed announcement regarding interest rates here this afternoon. Still finishing up earnings season, and here we are at the beginning of November. Just a couple months left in the calendar year here, 2024, which is nuts. And very importantly, the Cincinnati Bengals are traveling to Baltimore tonight to turn their season around. So very excited. Got a lot to do, including the fantasy football lineup. So we got a jam-packed show today. Won't have anything to do with fantasy football, but nonetheless, should be fun, entertaining, and hopefully you get something out of it. Well, welcome back to the show, Ez. Good to have you back on the mic. I know you're out there in California. I appreciate you being here with us this morning. Very early for most Californians. So thanks for being here.
Oh, happy to do it. I'm happy to be back. This is my home for sure. I may be out in California, but my heart resides in the north, south / lower Midwest, as we like to call the Ohio Valley.
Yeah, we couldn't have the banter of the last podcast or two that we normally enjoy, just for technical audio reasons. As you've moved your office, your headquarters, your life, for that matter, over to the West Coast. So appreciate you joining us. Good to have you back on the mic here, so we can chat about all the things that I think our viewers want to hear about today. So welcome back, man.
Glad to be back. And we better get a little bit of football talk in because I'm starving for it. I'm tired of hearing about the Rams and the Niners. I want some Bengals talk. But in all seriousness, I'd also like to say big appreciation to all of our viewers that stuck through the audio and some other technical issues we've been having. Um, I just want to remind everyone listening to this that for those of you that aren't clients of Shepherd Wealth Management, Joshua does this podcast to benefit everyone as a whole, but our main point of this is to provide support for all the clients at SWM. So you might not find some of the bells and whistles and the polish that you see on other podcasts because we're here just to serve the client. So for those of you that stuck with the previous technical issues as we worked them all out, can't thank you all enough. And we're back to banging out the true form as we figured them all out. So
That's right. That's right. So might as well just jump right into it because you weren't able to join the audio banter for pre-election, but now that we're
thank
post-election,
God.
we can talk a little bit. So nothing. This is definitely not a political show. I am not a political person.
Yeah, I don't think
Although
either of us are. Yeah.
I am a data person and I am a historical data person. So, as mentioned, we love doing this show. This is a different type of show. It is directly for Shepherd Wealth Management clients. If you're not a client, definitely consider it. A lot of good reasons for that. But the main reason for the show is just like election night. You can flip on a couple different types of media outlets. You could go, for example, more liberal news outlet and then go more conservative news outlet. And you'll hear people talking about the same topic, election, but with two completely different viewpoints, right? And there's nothing wrong with that. The news is designed as a business for profit. And in order for them to make a profit, they only have one way in which to do that, and that is to keep eyeballs on the screen so they can sell advertisements. Again, nothing wrong with the model, nothing wrong with either viewpoint. They're allowed to have those. That's one of the reasons that this country is great. But for my clients' purposes, for this show's purpose, we understand here at Shepherd Wealth Management that human beings make a market. We also understand that human beings, we're all walking around with these smartphones, which is awesome, right? It's great to have a full-blown computer and chat BT or AI capabilities all over the place to make your life simpler, more efficient, just more fun in general. Again, nothing wrong with that piece of technology either. But what we do know is that human beings get distracted. We're hardwired with these things called fear and greed, going back to caveman days. And there's a study called behavioral finance, which you can get a PhD in, and pretty much every major university these days. It's just a study of how human beings make decisions, specifically with their finances under stressful circumstances. And what we've learned, thanks to that study, is not only are human beings hardwired with this emotions called fear and greed, but we've also learned that human beings feel losses twice as much as we feel good about making a profit. And the news understands that. And that is the primary reason why they generally placate the human emotions fear side. Whatever your viewpoint is, generally the reasons why they're talking about whatever it is they're talking about. They're placating to that human emotion because they understand it's going to drive more engagement. It's going to keep you on the screen longer. Therefore, they can sell more advertisements. I don't have a problem with any of that. What I do have a problem with is, unfortunately, us as very busy human beings, and the news' unwillingness, or usually they don't provide historical context. And what we mean by that is there's almost always a precedent. Whatever it is that we're going through as a country, society, market, there's always been a precedent. I mean, the only caveat to that is the pandemic. Like, there's never been another precedent where the whole global economy shut down for as long as it did. I'll give you that. But outside of that, there's always been some sort of historical precedent. If you understand how other human beings have behaved in the past, all that's giving you is a couple of advantages. One, and Warren Buffett would say this is the most important one, is controlling your temperament. The number one reason he believes that individual investors, he being Warren Buffett, does not achieve the results they're looking for consistently is because they have no control over their temperament. In other words, they have no control over their emotions, those things called fear and greed that are inside of us as individual humans. Well, that's one way that we get a handle of our temperament, our emotions, is by understanding how other human beings have behaved. Because once we understand that, now we understand what the risk and reward are. We also understand what the probabilities of success are. So there's 11 sectors that make up a market. And if you understand what the things that did really well under, let's say, a Trump presidency, which we can actually compare to, we'll talk about some of that today. Now you're putting some of those this historical probabilities, how other human beings have behaved in the past, you're putting them in your favor because you understand what they are. And if, let's say, X, Y, and Z sectors did the best compared to everything else, now you can go to position yourself accordingly based on those probabilities and your individual risk tolerance and the goals that you have for your investments in your underlying portfolio. That's exactly the reason why we do this show, is because we don't believe the news or other outlets are doing a good enough job, or any job at all, in some instances, of actually providing their viewership. Hey, this is what's going on. This is the risk. This is the headline and our viewpoint on the headline. That's fine, but they almost never provide that historical context piece saying, oh, yeah, this is our viewpoint, but this has also happened 17 other times in the history of our country. And here's how things played out over the next 6, 9, and 12 months. You typically don't hear that. That's why we're doing this show. It is, in fact, a very competitive advantage for us here at Shepherd Wealth Management. And our clients would back us up 100% on that, because that's what we use to formulate an asset allocation strategy for our customers. And it's worked out very, very well from a performance standpoint. And of course, when human beings have less stress that we provide through this sort of historical data perspective, it also is a win in that regard as well. So everybody's looking for less stress and more money, more profits, more return for the risk that they're taking. And for us, this is our way of going about that. So hope you enjoy the show. If you do, make sure you subscribe, hit the notification button on YouTube. That way you're aware every time we drop one of these. And we try to do it about every 2 weeks. It's not perfect. We got holiday season coming up here, but about every 2 weeks we'll hop on here and try to deliver 30, 45 minutes of what's going on, but also what does history have to say about it, and then how we're positioning accordingly to take advantage of that. So
Yeah,
please
typically
enjoy
the
it.
only major delays we see are when you're busy with quarterly reviews too. So yeah, it is pretty much approximately. You get 2 shows a month, but sometimes that gets shifted around if we're particularly busy with clients.
Yeah, that's right. And definitely not wasting much time with fantasy football during that, because I'm 2-7, I think, on the year. So it's not been great. Maybe I should spend a little bit more time on that, but unfortunately, that's not what my clients would like me to spend time on. So we'll save that for after hours.
That's
Um,
good. That's the late night version of the SW, it's the Financial Shepherd podcast.
that's right. Actually, one or two of those losses is because I've been so busy with those quarterly reviews. I actually forgot to play people that were on a buy, and that cost a couple L's right there. So
Yeah, that'll
uh,
do it.
yeah, just so you know, I'm keeping the main thing the main theme here. It's just I like to get a couple extra ones in fantasy football, and hopefully that starts tonight with a great performance from our hometown Bengals here.
They
All
almost
right.
had him in the last one. I'm feeling good.
Well,
I'm
they
feeling
almost
good.
have a lot of people in the first 6 games of the year, but yeah, they should have won the last one at home against those guys, and hopefully they take care of business tonight on Thursday Night Football. But we'll see. We'll see. It'll be a packed house. It'll be a lot of fun to watch, and scored a lot of points in the last game, so I wouldn't expect too much of anything else other than that, really. But I'll be watching. Joe Burrow is the QB1 here for my fantasy football team. So last week crushed it. This week we need something similar. So I'll be watching closely or as well as everybody else here in the tri-state area. All right, enough of that. I could talk football all night, but we got to deliver what we came here to deliver today, Ez.
Yeah, we got to
So we
plug
are
this thing.
we are getting closer to the end of earnings season. We're not quite there yet. We still have several weeks to go, including some really, really big ones, such as NVIDIA coming up here later in the month of November. But as we're talking here today, we have 103 companies that are reporting this week. And of the 418 companies that have reported so far, that's 84% of the S&P 500, by the way. So of those 418 companies that have reported, overall, 77% are beating their estimates. And those that are beating estimates are beating by a median of 6%. So this isn't like, rip your face off type of awesomeness from an earnings perspective. However, this is strong stuff here. So the earnings growth expectations for this quarter is 5%. And again, that doesn't sound like, some sort of amazing sort of performance on the earnings standpoint. But two things to note here. A large majority, nearly 80%, anything around that 80% number considered very strong. Earnings seasons beats. And the other thing to note about that is as inflation comes down, and we're going to hear from Fed Chair Powell here this afternoon at 2:30 Eastern Standard Time, he's going to deliver a 25 basis point cut that is baked into the market 100%. He's not one to surprise the market, so count on that. You can bank on that. The most important thing about today is what he's going to say, and I'll talk about that here in just a little bit. But from the S&P's earnings conversation standpoint, as inflation comes down, as interest rates come down, that 5% earnings growth only looks better and better. Now, we'll compare that to earnings growth expectations for small caps as an example. I mentioned this in a prior podcast. One of the reasons why we're really excited about the small cap asset class, which has been a major underperformer relative to the S&P 500 for over a decade. But one of the things that gets us excited about that is not only is the PE ratio lower, so you're getting a better value, but you're also getting more earnings growth expectations out of that. So actually, small caps as an asset class have an earnings growth expectation around 40%, which is obviously pretty dang attractive, specifically when you compare that to something like the S&P. So we'll talk more about small caps specifically here in just a minute, but that's where we stand on the earnings standpoint. We also got some data today regarding jobless claims. So jobless claims did rise to 221,000 last week from an upwardly revised 218,000. I don't think that's going to have much to do at all with the decision today regarding interest rates, but it is something that obviously we want to keep an eye on. If there's any single data point that's the most important one, this would be it. The reason for that, the market, the S&P 500, is just a whole bunch of human beings, consumers, as I mentioned at the beginning of the show. And 70% of the U.S. economy is consumers consuming things. And the only way that they can consume things is if they have a job. Because eventually, if you don't have a job and you're still consuming, well, eventually you're going to run out of credit. So therefore, that is the single most important data point. If that rises to something north of 4.4, 4.5% unemployment rate, then you're talking about things like recession possibilities, et cetera. But anything below that 4.4, 4.5 unemployment rate, which we are substantially below 4.1% on the unemployment rate right now, that's basically considered full employment. So nothing to get alarmed at, just something worth noting. And I'm sure Fed Chair Powell will get a question or two about that today. Obviously, his responses are going to be way more important than the actual action of a 25 basis point cut. Because the market is forward looking. And I'll have some of my thoughts about that here in just a second. So here's where we stand on the earnings front as well as the inflation front. Wanted to share a little bit regarding today's news. If I can find it real quick here, Ez. Probably not. So we'll actually get to today's Fed meeting. And right now, you got 100% probability of a 25 basis point cut. There's about a 67, 70% chance of another 25 basis point cut at the next Fed meeting in December. The prior Fed meeting, there was a 50 basis point cut. So half a 1% interest rate reduction. And the market's now pricing in again today's as well as December's probabilities as I just outlined there. The market is trying to figure out from what Chair Powell is going to be saying today is how their monetary policy approach is going to look next year as transition of power happens in January with the new president and the cabinet associated with that. That's really going to be the main takeaway is the Fed going to be data dependent going into next year? And I think the answer to that should be yes. I think that should be the market's expectation. There is no reason to deviate from the path that they're on right now regarding the 25 basis point cut today, as well as next week. And the reason for that is the data hasn't, forced their hand to change their stance. Inflation continues to come down. Housing inflation, specifically in the most recent report, was the biggest standout because it finally started to show the biggest progress as far as disinflation is concerned, and that is the heaviest weighted thing in the entire CPI calculation. So I'm sure that you'll hear Fed Chair Powell talk about the housing market here today as well, but nothing on the unemployment rate, nothing on the jobs data, nothing in the actual inflation data would deviate the Fed from its current path of 25 basis point reduction today. And I would also expect the exact same thing in the December meeting. Um, and until that changes, and that's what I'm looking for today, is I really would love to hear Fed Chair Powell say, "Hey, until the data changes, our monetary policy stance should not change. We can because we have a very full labor market, a resilient labor market, a strong economy, a strong corporate earnings, news that we're getting on a daily basis right now. Because of all those things, we can take our time in reducing our stance on monetary policy and allow the data to continue to come in, and we'll adjust accordingly if needed." That's really the truth. And that's really all I think that needs to be said. I'm sure he'll get a ton of questions, but if that's the answers, then I think Wall Street, specifically, the markets will respond very, very excitingly for that. And that's the expectation that I have here for today regarding the inflation news. I don't know if there's anything that you're looking for to get out of today's inflation front, Ez, regarding the Fed Chair Powell's comments. Not sure if you're looking for any buzzwords there or not, but the market is certainly not going to care too much about the 25 basis point cut, although that is what is expected. So if we didn't deliver it, that would be straight up chaos. So that's not going to happen today. But anything else that you might be closely monitoring or paying attention to as regarding the shift in power coming up here, or really anything else?
Not so much the shift in power. I expect that to go pretty smooth. There's no indication that anybody's going to do anything out of the ordinary. But today, for sure, I'm looking for the Fed to get out of their I'm looking for assertiveness. I want to see confidence and assertiveness, even if it's short and sweet, nothing too example. Just, yeah, we're going to cut this one and we got another one coming. Like you said, we're sticking to the data from here on out. And that's it. I just want to see confidence that they know at least a course. None of this, like, well, maybe this and then that.
Right.
We would call that dovishness. None of that, like, just kind of like, well, whatever, we'll see. I want to know that they understand how the next few months are going to lay out for them. I mean,
100%.
I just expect them to know what they're doing and to know how to pivot if they need to, because they got those jobs, right? You know what I'm saying? So when they
100%.
kind of come across in their talk about, well, we'll pivot if we have to me, that just like throws the market into chaos. So I want to see them just go down the line.
Yeah, I want that. I want the confidence, and I know that he's going to get questions regarding, well, is your monetary policy decisions going to change given the new president, new cabinet, new Senate, new House, all these things? And his answer should be unequivocally no. I mean, they are a completely separate entity from the White House and every other office in this country, and that's not going to change either. I know that there was a lot of rhetoric regarding, well, is the Fed going to stay, independent or not? They're going to stay independent. There has already been a precedent for this with this administration. Obviously, there'll be different cabinet members and so forth, but Fed Chair Powell was around then. The Fed was around then. They're still around now. They're not going to go anywhere. It would be very, very bad for the U.S. economy if that were to change. And I just don't believe that after running on making America strong again, that would change. I just don't believe that, but we'll all have to wait and see that. I'll believe it when I see it. But given the precedent that we already have, there's no reason to worry about that. Although I do believe that there will be a lot of questions about that. So to your point, as I'm looking for confidence on the economy side of things, and I'm looking for some assertiveness regarding, their ability to make data-dependent decisions regardless of the circumstantial changes in Washington D.C. 100% agree with all that. Now, this is a program where we like to look back at history, and we like to look at history because it gives us probabilities. It helps us understand the risk and reward. Therefore, we can start to make some educated decisions regarding things like stock positioning and asset allocation. So the first thing I wanted to look at, since we're talking about the Fed today, and they're going to make an interest rate policy decision today, I wanted to take a look at what inflation looked like back in 2016. So essentially, the last presidential cycle was late 16 through 20, and inflation never got above 2.4%. So it rose to 2.4% in 2018, but that was as high as it got. Now, obviously, right now we're coming down from 5.5% Fed funds rate to hopefully the neutral rate, which we don't really know what the neutral rate is, and all that simply means is you have monetary policy situated such that the Fed funds interest rate is not hurting the economy, but it's certainly not providing any boost to the economy. So it's quote unquote neutral. Um, I believe that it's somewhere in the 3.5 to 4% range. And I think most economists are looking for the Fed to try to get closer to 4%. We're about 4.75 to 5% on the Fed funds rate right now, based on that 50 basis point cut. So if we get another 25 today, then we'll be sitting somewhere between 4.5 to 4.75. So there's still another 50 basis points, in my view, worth of quote unquote easy cuts. I doubt that you're going to hear that from Fed Chair Powell today. If he were to say something like that, that would certainly be a nice little boost to the stock market. But definitely do not anticipate him saying that at all. He does not want to be pigeonholed into a comment that he made about neutral rate, and then we get there and it's really not a good decision to either keep policy where it is or adjust it. So he's not going to put himself in that corner. He'll give himself plenty of opportunities to adjust if needed. So that should be the expectation for today. Now, inflation being what it was back in that prior administration, I'm about to get to some sector and very specific market performance things that ties into what I'm sharing with everybody regarding inflation in that administration's tenure. And then, of course, the market returns, the S&P 500 return was 19.3% from the close of November 8th of 2016 when Trump was elected through the close of March 16th of 2020. So pretty strong economy, low inflation. We had a low unemployment rate as well. All very, very similar things except for the inflation piece right now, right? We're trying to get back to 2% inflation like we were, for many, many years um, prior to the great pandemic, which of course was a big reason for the inflation that actually has occurred. There were other things that contributed to that, but certainly the spark of that was definitely COVID. Now the Dow Jones over the same period of time, just to round it out, the major averages, Dow Jones returned 10% over that 3+ year period, and the tech heavy NASDAQ was up almost 38% over that period of time. So I think there's a lot of very similar things here. The only difference is we were already in a low interest rate environment. Fed didn't need to do anything with their policy over those periods of times until we got to COVID. And now they're reducing interest rates. So when you have a strong economy with a very strong labor market and we're reducing interest rates, I mean, that's a pretty good backdrop, pretty good list of ingredients there to expect a lot of performance from the markets themselves. Now, with that as our backdrop here, and oh, by the way, this administration has campaigned on reducing things like regulation, taxes. All of that is going to affect the bottom line and the earnings growth expectations. So again, it's just very, very stimulative regarding things like risk assets in the stock market. Now, speaking of that, wanted to transition to some other historical data points here, because again, this is unique that we actually can compare an administration that's getting ready to take over again to what they've already done in the past. We don't have the opportunity to do that, but this time we do. So now let's go ahead and make those comparisons. So if you go look at the market since 1900, the 3-month forward returns from a presidential election are very strong, and a lot of it has to do with the relief rally. So, and the reason why I bring this data point to everybody's attention is you might be celebrating, what has happened here on election night and the results of that. You might be depressed, distraught, completely sad for a moment in time right now. But this is just what the market looks at. Truly, the market doesn't necessarily care who if your favorite candidate got elected or not. It's going to continue to move on. And the reason why it has to move on is because the market's made up of human beings, and these human beings are CEOs, CFOs of publicly traded companies that are charged with reporting their progress, their performance every single 3 months. So they have to move on. But the market tends to have this what we call relief rally post presidential elections. And this time is going to be no different. And history says that the post relief rally happens nearly 100% of the time, and the average 3 month forward return post presidential elections since 1900 is just over 7%. So, again, you could be happy, you could be sad, but if you're just making decisions on whether or not you're going to participate in things like risk assets based on whether or not your candidate got elected or not, certainly could be very costly for you from an opportunity cost perspective. So that is the data, and I give all that to you all to begin this discussion because you may be happy, you might be sad, but the market's going to move on. And when we compare things to the prior administration that's getting ready to take over again's performance regarding things like the stock market and specific sectors of the market, kind of wanted to go over some of those numbers with everybody as well. Now, the number one thing that is brought to me post election night, you know, was, hey, I want to be in energy. Now that the Trump administration is going to take the White House, Republicans have the Senate majority, and it seems as though they're likely to have a House majority as well. We don't know that for certain just yet, but that's what the data is pointing to. They're saying, hey, he's going to be able to approve, all this energy production for every commodity. Whether your opinion about that is very bullish or not, here's what the actual history has to say. If you go look at, and you can Google this, you have AI capabilities on, pretty any search engine you want to go look at. So you can take my word for it, or you can go Google it yourself. If Trump decides to pass all these energy policies, again, right or wrong, you can have your own opinion about that. But here's what the commodity, and we'll use oil as an example just to make it simple, but you could use this with natural gas, you could use it with any commodity. If you're going to increase the supply of oil, let's just say, and the demand stays the same for oil, again, you have more supply, demand is the same. That means the price of that barrel of oil is going to go down. That does not mean that Marathon and Chevron will not make money. They will still make money. But that also means that their growth is not going to be as attractive as other companies like, let's say, NVIDIA, as an example. Okay. And if you go look at history under the last administration on the energy perspective, again, I got a lot of questions, a lot of people texting me saying, hey, I want to be in energy types of positions. My answer to them was not only, hey, here's the simple economics of supply and demand for those commodities, but oh, by the way, since we already have a history of this administration's performance, specifically for energy, well, the prior administration for Obama, as well as the Biden administration, was much better for energy stocks. And the reason for that is they tend to not want to increase the supply. They tend to not drill as much. Tends to be a little bit more regulations as it relates to all of those things. Again, right or wrong on that, I'll leave that up to you. But the fact of the matter is, because there's less supply coming out of the United States and demand is staying the same, well, that would mean, in theory, the price of oil in this example is going to increase. And that increase in oil price, that commodity, is really what makes owning things like Chevron, Marathon, Shell, BP, et cetera, all of those major players in that energy space, those are very attractive. As demand is either increasing or staying the same, but supply is coming down, that simply just means the price of barrel of oil is going up. And that makes the earnings very, very exciting. It actually makes a lot of those, oil producers, drillers, kind of makes them look like a tech stock, like an NVIDIA. under those circumstances. And you don't have to go very far. You can go back to 2022 when the market was down double digits. Well, energy, one of the 11 sectors of the S&P, the smallest sector in the S&P, was up 50%. Okay. And that was, again, that had a lot to do with the fact that demand was fairly high, the production was very low, the price of oil was very high, and their stock price performance looked like a tech stock. So you can already look back at the history of that very simple example and understand, okay, well, the probability of me making money in energy stocks is probably a little less than what it has been, if in fact they pass a lot of these pro-energy policies that they've campaigned on. Now, getting back to some other historical concepts here. So 2016, under the Trump administration, the market did great. We just kind of talked about that. But small caps did even better. Small caps were up about 16% just in the first 3 months, roughly 3 months post-election. Bitcoin, substantial performer. I mean, that thing has just exploded, here as of recently. But if you go back to the Trump days, 2016, you're talking about a move from around about 115 when he took over, and to about 150. I'm just making the numbers simple here, just to make the math a little faster while we're doing the podcast. So we're talking about what, probably should have had this written down, 30% move in just about 3 months once he took office there. Now we're seeing some of this already. So yesterday, the S&P 500 was up 2.5% in one day. The Nasdaq was up over 3%. Bitcoin asset prices were up around 10% on the day, and then small caps as an index were up about 5+% just in one single day yesterday. And I've been talking about all of these things pre-election for many, many months. You can go back and look at the actual YouTube videos. We actually have video evidence of this. I write about the same stuff. So tomorrow I'll be writing a newsletter for all clients. I tend to write a newsletter at the beginning of every month, tend to write a weekly blog, and we do this show every 2 weeks. So everything I'm about to say today is also going to be sent out to clients, in writing, maybe with a little bit more color and context behind it. But we're already seeing, this history play itself out here today and yesterday. Now we were positioned for small caps, a Bitcoin miner, which I'll reintroduce to the audience here again today, as well as industrials, and of course a little bit of tech. But those three big spaces, small caps, industrials, and Bitcoin, specifically a miner position, for several months leading into the election night. And the reason for that had very little to do with the election. It had everything to do with the forward path of interest rates. We were positioning based on what we did know. We didn't know what the outcome of the election was going to be. I don't think anybody had any idea what the actual outcome would be. They might have had their hopes and dreams for that election, but they didn't actually know, right? But what we had to do was make decisions for our customers with what we did know. And what we did know is that as interest rates come down, historically, small caps tend to outperform everything. And that typically doesn't happen until you start an interest rate cutting cycle, which we just started that just a couple weeks before the election. I think that you're about to see the fruits of that here from today and beyond. Now that we're post-election, Powell's going to talk today. He's going to cut rates. He's going to give you some guidance, I hope, regarding the future path of monetary policy, and that would be huge for today. But we did know pre-election that interest rates were coming down and the Fed was dovish. So what does well? Small caps do great. Very risk assets like Bitcoin are going to tend to do much better in a lower interest rate environment. And things like manufacturing, which is still a huge component of the U.S. economy's GDP. And manufacturing is a very expensive process, a very expensive business. As interest rates come down, it makes it much more attractive for those types of businesses to reinvest into their company, make things more efficient, et cetera. And, the Dow Jones is up over 3% yesterday. I think it had something to do with the election results being over. I think it had something to do with the policies that are expected given the election results. But more than anything, it has to do with interest rates coming down and will continue to come down into the future. Those are the three things that we've significantly overweighted for clients. Yes, we still had some tech exposure. Obviously, you want to have some tech exposure. It'll get invested in regardless of who's in the White House or in the Senate. Tech is going to be something that affects every industry and for every person. And it is the biggest sector of the S&P 500. But the three big ones for us, overweight wise, small caps, Bitcoin, as well as industrials. And yesterday was a microcosm of what I expect to continue to happen, not only for the remainder of this year, but into the first quarter of 2025. So that was the history of the market during a Trump administration, both on the S&P as well as a couple different sectors. But I also wanted to break down a couple of specific sectors within the S&P 500 itself. So I just talked about small caps doing exceptionally well. And oh, by the way, the history of small cap performance, again, I talked about this in prior podcasts. When you start a rate cut cycle, the 3 month forward average return for small caps has been 7%. 6 months out, it's closer to 15%. And actually, 12 months out, believe it or not, the average is closer to 51%. Now, these are averages, so it could be better or worse. And of course, past performance is no guarantee of future results. Investing involves risk, including risk of loss. But last year, very simple example, November 1st to December 27th, um, small caps were up 27% over those final few weeks of trading. And we didn't get an interest rate cut until just a couple of weeks ago, right? So almost a year later, we got that rate cut. But the reason why small caps did so well is Fed Chair Powell said, hey, we finally saw inflation come down. As long as this continues, we don't anticipate increasing rates. So just saying that sparked a 27% rally for small caps. Now, they haven't done much since, only up about 10, 12% or so year to date. So definitely underperforming the S&P 500. And we thought we would see a lot more rate cuts at the beginning of this year. So we had small cap exposure coming into January. Did okay. We didn't get those rate cuts. We confirmed that we weren't going to get those rate cuts early on in the year. So we, basically got out of or had very little exposure to small caps. But now that we're here, and we were pretty confident that rates would start to be cut, thought they should be cut into July. It didn't happen. Part of the reason why we got the 50 basis point cut we did a few weeks ago. But we do know now, and we did know before the election, that the path of rates was going to be lower. And the history of those asset classes, specifically small caps performance, is very, very strong and very, very hard to ignore. The other part, or the other sectors that are worth mentioning here as well. So the financial sector, during the last Trump administration did phenomenal. Again, you would expect that to continue. Why? Well, interest rates are going to come down. As interest rates come down, loan demand goes up. We already know there's a huge demand for housing in this country, as an example. But the other reason why financials did so well was a little bit less regulation. All of those things will add to the bottom line for financials. And by the way, if you're using an index like the small cap IWM index that we use for that exposure for small caps, that's the Russell 2000 Index ETF. Well, 37% of the small cap ETF is financial institutions. They're just smaller banks. Think of regional banks that are publicly traded. Same idea. Loan demand going up as interest rates come down. Financials did great. I expect those to do great, and it is an asset class worth considering an overweight for. Now that we know the outcome of this election as well. Industrials, we already mentioned that, did great in the last administration. Discretionary, obviously, also did well. But the things that did not do well, believe it or not, technology did not do very well under the Trump administration. Neither did materials or energy, as we've already mentioned. Healthcare, staples, and utilities all performed poorly as well. But those are more defensive types of sectors. And we were certainly in a bull market during pretty much the entire 2016 to 2020 presidency that Trump had during that period of time. So again, small caps, financials, industrials, and certain parts of tech will do well, and that would do well regardless of who's in the White House. But the last thing worth mentioning here today, since we're getting into rate decision time, we have the Federal Open Market Committee decision today. We'll get that announcement at 2 o'clock. but the presser, all the questions and so forth, will come right around 2:30. So we're actually able to pull up some data regarding this, and we wanted to see the S&P 500 price reaction since 2022 for Federal Open Market Committee meetings. So the price action for this type of meeting. Now, the average performance leading into the announcement, which will happen at 2 o'clock, is positive. It's about a half of 1% positive performance with a win ratio, meaning the market's positive about 88% of the time before we get the actual 2 p.m. announcement regarding rates. Once the presser starts at 2:30, the win ratio drops to 75%, and the average performance is only positive zero point 0.2. So you're already seeing a drop there. By the time we get to that 2:30 presser, when he's actually taking questions, the win ratio drops to 38%, and the average performance is actually negative 0.13%. So that is the historical data. But the 5-day and 10-day post reaction for the market is positive 75% of the time, with the average being 10 days after being 2.1% on the S&P positive, and again being positive 75% of the time. So you can actually look at this historical data, although it's not that far in history. This is only going back a few years, but probably a good data set given the fact that we haven't had a lot of very really important reasons to be glued into the Fed. We've been doing that really since the pandemic and the inflation spike that has happened here. So that's why we're looking at this data set the way that we are. But 10 days post the announcement, on average, up 75% of the time and positive 2.1%. Now, we think the market could actually produce maybe about another 7% on top of where we're at here today. We could be looking at the S&P around 6,300, given the historical precedents that have been given here regarding the prior administration's record, getting ready to step into office post-election, as well as what's historically precedent for the Fed's interest rate decisions here today, on top of a strong economy, strong labor market, great earnings, and interest rates and inflation coming down. There's a lot of reasons to be very bullish. And there's still $6 trillion sitting in cash in a year where the stock market's up over 20%. I'm not sure when all that cash is going to get put to work here, but I do know that there's a ton of people that are probably regretting some decisions that they made to be so risk averse. This year, I'm sure that they're very cautious. Or at least some of them are probably very cautious coming into 2025 for their own specific reasons. This is why we do the show. I mean, I'm having a very difficult time seeing the downside from all the history that we've just kind of laid out here today. And I'm very, very bullish going into the back half of this year. If we do get any volatility relative to today's presser, then I'll probably just look at that as an opportunity to rebalance out of some of these ETFs that we have used for clients. So, for example, pre-election, we didn't want to take on a ton of individual stock or individual company specific risk. So instead of owning individual tech names, as an example, we would own the Qs or the entire NASDAQ index ETF. Well, we would prefer, and we've told this to all clients during our quarterly review time with them, that we would prefer to own individual names like we have in the past, but we didn't see a big reason to take on company specific risk going into an election where we don't know what the outcome is. But now that we do know what the outcome is, it starts to make a little bit more sense to us to consider owning those individual names again. So part of our dollar cost averaging strategy at this point, given that we are fully invested, is if we do see some volatility in, let's say, something like the NASDAQ coming into today's meeting with Powell, as well as maybe tomorrow, we probably will take some of the profits that we made in the NASDAQ ETF, the triple Qs, sell some of that, and use that capital to go ahead and buy individual names that are already in that ETF that we really want to have exposure to, not just for the back half of this year, but for Q1 of next year. Just remember that this is Q4 right now, October through December, and we won't know what the earnings are for all these companies until we get into earlier part of next year. So with all of that, I am very, very bullish. I know that there's a lot of emotions going on right now. But that's the reason, again, why we do this show is to get into, okay, yes, there are emotions. We feel them. I am no less of a human being than anybody else. But what we also need to understand is amateurs want to be right, professionals want to make money. And we are here to make money for our customers. We want to do that in a very professional way. And the best way that I know how to do that is to go ahead and look at how other human beings have behaved historically under very similar circumstances so I can get my emotions under check and then look at what the history of risk and reward is given the performance of all the other human beings that have made decisions in under similar circumstances. Now I have that probability information. Now I have the confidence that I need to go in here and make decisions on behalf of our customers and for my own portfolio for that matter. So we're very, very bullish. And I think that you should be too. I've said it all year long about small caps. I expect a lot from it. And I'm not here to say I told you so, but I kind of told you so. Because there's not that many people on CNBC or whatever news outlet that you're getting a lot of your information from that are behind that particular trade. But that is not a trade for us. That's definitely investment. I said the same thing about manufacturing. And as far as the Bitcoin goes, I mean, you play that a lot of different ways. We like to do that through a minor micro strategy. Pull up the ticker symbol MSTR. The chart on that's phenomenal. It's not a recommendation for you. It is a very, very volatile position for sure, but it is a holding for our clients, and they're all very happy and thankful for it. They're essentially just mining Bitcoin. They're also using leverage to acquire more coins. And they can do what they want with them, keep them on the balance sheet, sell them, etc. But it's kind of like the picks and shovel as opposed to directly investing in the asset class itself. Very, very similar to NVIDIA. NVIDIA is the picks and shovel for AI capabilities. You have to have their stuff in order to do the really cool things that we're hoping AI will be able to do for all of us. But there's also a million other ways to go ahead and play that same sort of concept. But that's what we're doing with the crypto play for our customers. And of course, yes, we still have tech, and we just talked about how we'll get into the individual positions there. So, with that being said, our price target for the rest of the year is 6,300 on the S&P 500. We might not get that in a straight line, meaning that we're probably not just going to see the S&P go from um, 5966 is where it's at here at this very second, directly to 6,300. You'll probably see some backing and filling um, between now and the end of the year, but I have a very difficult time but obviously the remarks that Fisher Powell has today will mean a lot. But I have a very difficult time with everything that we just laid out, both from a historical perspective, a fundamental perspective. Um, I just have a very difficult time seeing why so many people are speaking, with their own decisions by keeping that much in cash. I don't see what the big fear point is. I mean, obviously, there's always geopolitical risk. You cannot diversify outside of that. So if that's the reason for not investing, then you'll never actually invest because there's always some conflict going on somewhere in this world. That has been true since the beginning of time. But outside of that, I just have a very difficult time seeing the rationale for being so fearful. And that's why we want to do the show. I don't want you to feel that fear. It's okay to feel emotions, um, but there's a way to go about making yourself some money without taking on unnecessary risk. And that's hopefully what you're getting out of this show. So I'm very, very bullish and excited. Gave you guys my price targets and all the reasons why we can anticipate seeing some results like that. And I'll eat the words if I'm wrong. You guys will get to say I told you so every 2 weeks because I'll be right here. But we've gotten this right a lot. We've gotten this right throughout last year when nobody thought there'd be double-digit returns. We laid out a big case for that in January of last year. We haven't been perfect this year with the timing of every rebalance, but from a positioning standpoint, looking through the market through this historical lens has definitely been an advantage for our customers. And I couldn't be more proud of the work that we've done and the results that we've given them, as well as the service behind it. But people that have reached out to me, I've been unwavering in the confidence that we have for all the reasons that we talked about in this particular show. So, looking forward to seeing what happens here in the rest of the year. With that,
Yeah.
is I think that I've covered everything on my notes. Anything that you want to leave us with?
No, you Sherpa'd us through this one again. So
That's the game plan. I appreciate all the support Again, Shepherd Wealth Management's been around about 3.5 years now. We're serving clients 15 different states. Hope to be in all 50 states one day. We can work with anybody in the United States, of course, but currently clients in 15 separate states. Just under $110 million that we're managing, and we could not do that without the support of our customers. But if you're enjoying the show, if you are a customer, please share this with somebody that you know, like, trust, and we love your feedback. We're here on YouTube, like I said, about every 2 weeks. So you can leave a comment, a question right there. You can also call or text me, 513-630-2664. You can also check us out on shepherdwm.com. A whole lot of background information about myself, the company, as well as my business partner, John Ashcroft. And I know that we're at the very beginning of a new calendar month with a whole bunch of macro news, political news, geopolitical news that's all around us. Just remember, everything's going to be just fine. And if there's anything that we can do to help resolve some of those concerns and pain points that you have that you weren't able to get from today's show, please just call me directly. Even if you're not a client, this is what I believe that I was put on this earth to do. I've given a specific skill set to help people with this, and I'd be glad to help you. But also would love to have you part of the Shepherd Wealth Management family of clients that we look forward to celebrating with as we wrap up this year and head into 2025. So I appreciate all the support. We'll do this again in a couple weeks. I hope you guys have a great Thursday evening, Who Day, and we'll see you next time.